Welcome everyone. We are back in Mere Finance for our weekly overview of the market. And this week we have the pleasure to talk about the mortgage-backed securities. MBS, is there an imminent crash in the housing market or is it an investment opportunity in the US? So let's explore because it's a heated debate among scholars, investors, traders, lenders, homeowners, etc. Before you start, we need to understand that most of the current financial markets seem to have commodities apart, but there is a clear connection and link between commodities prices, stocks, and bonds. And I believe commodities are the best indicator to predict the future of both bonds and stocks. Why? Because an economy needs resources, right? And resources are scarce. So what the free market means is that we try to allocate those resources what is better, right? That's the free market principle. So we need to understand that lumber, for example, is a clear indicator of housing, and housing is a clear indicator of the whole economy, because when you have a house, you spend money on your mortgage, you spend money in refurnishing it, you spend money on electricity and so forth, and you create a whole neighborhood and so forth. So it's one of the best indicators of how the economy is doing. So each house has around 16,000 broads of lumber. It's amazing. Also cement. It's used for buildings, roads, ramps, ammonia for fertilizers, plastic for computer and healthcare products, steel for cars, bridges, scalpers. All of them also need fossil fuels, but that's another topic. So it's a huge indicator. And of course, if we don't have fossil fuels and we don't have available fossil fuels, none of these components will work and the whole economy will crash. But that's for another topic. So let's start with lumber, because lumber is our key component in the housing market. This is the graph for current contract in front for lumber futures. Basically, we're going to look from 1992 until now. So we are going to be everything we're going to be looking at in a 30-year rear view. Look at that. Lumber has to go down another 50%. It's currently around at 396. It has to go down another 50% to reach the mean or to reach the below pandemic levels. It's a 50% crash. If lumber keeps going down, the housing market will collapse. The whole economy will collapse. It's going already down. Look, even at the beginning of the year, in January, it was around $1,500,000. Now it's trading under 400, and it still has a long way to go to 300. Some people say 300, but I will say 200, but I think that's a little extreme. So when you see this, you also have to go in that we are experiencing the fastest housing slowdown on record. So this is the cumulative change in existing single-family home sales during Fed hiking cycles. So we have 1977, 83, 94, 99, 2004, 2015, and 2022. Look at the plumbing, the red line to the left. This is from Apollo. 23% in sales for the year. 7 months from the first hike. It's tremendously the way it's crashing. And look at this. The months of supply available on the market is currently 1.8 year over year. This is the 4-week rolling average of months of supply. Look at that. 2020, 2021, 2022, it just totally up. We'll still have to reach the 2020 levels. Look at the left, 20 levels to the left in January. Market is, of course, cyclical, right? There is times in the summer where you want to sell. In winter, you usually don't sell. But even in the winter, it's just going up so high that it's going to cause severe damage in the prices. So that's the case for an imminent crash. Lumber, sales, and supply. But we have to also look into the quantitative analysis. This is our market yield on the US Treasury securities at 10-year maturity, so our yield for the 10-year, and the 30-year fixed rate mortgage average for the US. So why is this graph important? Because the 10-year usually defines when the Fed hike or when is done, and when the Fed terminal rate is also done. So we're going to see that they are very correlated, right? Look at this. Both mortgage rates and the 10-year are very correlated, and there is always like a constant spread. So let's check that spread over the last 30 years. Here, I did this graph. We have the spread. The average is 1.73 for the last 30 years. You can see there is a shadow of yellow. That's basically your rolling average, and it's very, very close. So that's basically saying, okay, your 10-year was, I don't know, this amount. Let's look in 2 months after, and that's the yellow line. So it's still very close to the spread of the regular spot point between 30 mortgage rate and the 10-year yield. You can see how in 2008 it went up. In 2022, currently it went up too. So usually in times of crisis, spreads tend to go up, which is regular conditions. But let's then check the primary mortgage market survey, which this is by Freddie Mac, and we're going to see a key overview of the market. So based on that, our 30-year currently is at 6.49, right? The 52-week average is 5.1, and a year ago, the 30-year was around 3%. So that's 100% increase, more than 100% increase. And 1 year is 3.3% increase. That's tremendously, right? It's a lot of increase. Imagine your mortgage rate going from 3 to 6.49. And the year all-time high for the 52-week range is 7.8. And we here in Mirror Finance, based on our quantitative analysis, believe this is the top. Now we're going to explain why. If you see new home sales month over month for the month of October, so October comparing to November, went up 7.5%. And if you see here, I circle it, year to year, time on the market is 4 days faster. So imagine this, interest rates have gone up, mortgage rates in the 30-year mortgage rate has gone up in a year in 3.38%. But yet, with a huge increase, time on the market for houses are 4 days faster. So they're selling 4 days faster in comparison to last year. A median listing prices is also 13% up. So this is a huge evidence that the housing market is still relatively very strong. And we also have, as we saw last Friday, that the labor market still very strong. It's still showing signals that is in a hot state, that wages are going up, that it is hard to find labor, and that because of the nature of the labor in the housing market, most of the skill set is usually taken by immigrants. So if you have that issue of labor and immigration and forcing wages to go up, then your prices of houses to build houses will go up, even when rates are going up. So that's a little problematic for the case that the housing is going to crash when your time on the market is going down, even after raising your rates by more than 100%. And here's what we want to see. So if our spread between the 30-year and the 10-year is 1.73 on average for the last 30 years, right? Let's check what's the average for 2022. So the average is 2.47 between the 10 and the 30 years. So based on that, the 10-year peaked on November 24th, right? With a yield of 4.25. So if we add the average spread, which is our normally high for the year, and we add it to the 10-year peak, we get around at 6.72. So in theory, 6.72 should be your top of your mortgage rate, and we already hit 7.08. So this is quantitative evidence that mortgage rates probably peaked already. Then financial conditions in the mortgage market will start to go down. So mortgage rates will go down, which is exactly the opposite of what the Fed wants to control inflation, because shelter is a big piece of this. So if you make financial conditions looser, then the demand for housing will still be strong. So I think it's a key element that we think the mortgage rates just peaked. So we'll see. This is the argument that still the market, as we say, is very strong, extremely strong still. But we can see a slowdown, but it might be temporarily. Vanguard says the MBS, mortgage-backed securities, are not attractive yet. And then we can also see that Realtor is the only largest real estate company to lay off employees due to the market slowdown. Compass and Redfin both laid off hundreds of employees in June and also in September. So there's a clear sign of slowdown, but it might be temporarily. I think Mere Finance still decided, based on a quantitative analysis, that yes, mortgage rates have done, but there's also more to look into it in the labor and in the comparison to other years. And then the United States S&P Case-Shiller, which shows the median price for the 20 biggest metropolitan areas in the US, you can see it's going down, but in comparison to December 2021, still up from 285 to 306. There is a clear downturn, but still holding there really high. So also building permits are going down, right? From 1564 to 1512 month to month. Housing starts also going down, which means less supply, which means higher prices for houses. But on the other side, new home sales are still going up. So we don't know. Building permits down 3.3 and home ownership still strong. So it's a confusing market in this. We believe mortgage rates will definitely go down, but house prices, we're not sure about the direction. So what do you think? We want to hear your opinion, your analysis. This is what we present. If we were an investor, we wouldn't bet on either side. We will bet that financial conditions for mortgage rates are going to be loosened, but that doesn't necessarily mean that the market is crashing or it will just go up. It's a heated debate, but we just wanted to present with the facts. So if you like this video, don't forget to subscribe, follow, and be safe out there in this winter. Thank you.